S&P 500 Index, SPX, current chart analysis. Bearish signals emerge. In this video, we will analyze the recent chart movements of the S&P 500 Index, SPX, and discuss the bearish signals that have emerged. The analysis is based on long-term chart analysis and aims to provide insights for investors looking to navigate the current market conditions. Last week's performance. Last week, the S&P 500 Index, SPX, showed little change and continued to hold above support. The index gained a fractional 0.46%, indicating a relatively stable market. Exiting to cash. This week we have decided to exit to cash from the S&P 500 Index, SPX position, which has been bullish since February 15, 2023. Several key indicators have prompted this decision. Firstly, the 200-day average line has been broken to the downside. Additionally, the rising trend support line from October 2022 has failed, along with the failure of the Wave 4 high as support. These developments suggest a shift in market sentiment. Conservative S&P 500 strategy. The conservative S&P 500 strategy aims to protect investors from bear markets by adopting a long-term approach. Short-term declines are expected and should not trigger sell signals. This strategy is not influenced by emotions or news events, focusing solely on long-term chart analysis. It allows for market fluctuations without attempting to time every minor up and down movement. Currently, the strategy is in a bearish position and holding cash in money market funds. Small caps and market weakness. Last week, small caps experienced a significant decline, dropping approximately 3.4% in just 2 days. This weakness in small caps, which are primarily traded by individual investors rather than computer-generated programs, is a cause for concern. The so-called death cross, where the 50-day average line crosses below the 200-day line, further confirms the bearish sentiment. Technical supports broken. Over the past few days, several technical supports have been broken, leading us to move towards cash in almost all positions. The SPX broke below its Wave 4 highs and its long-term rising trend support line. Additionally, it closed at new correction lows, losing 2.39% this week. The NYSE advanced decline line has also broken below its rising trend support line, indicating a potential bearish crossover in the near future. Impact of mortgage rates on home sales. The highest mortgage rates in 23 years have had a detrimental effect on home sales, which have reached their lowest levels since the subprime crisis period. Economist forecasts suggest that sales of previously owned homes in 2023 will dwindle to a rate not seen since at least 2011. This decline in home sales reflects the impact of rising mortgage rates on the housing market. Market breadth and mortgage demand. Market breadth continues to worsen as indicated by the advanced decline charts. Both charts are below important support levels and are heading lower, further supporting the bearish outlook. The average rate on the 30-year fixed mortgage rate has reached 8%, the highest level since mid-2000. This surge in rates has caused mortgage demand to plummet, with applications falling nearly 7% last week. In conclusion, the recent chart analysis of the S&P 500 Index, SPX, suggests a bearish outlook. Key indicators, such as the breaking of technical supports and the weakness in small caps, indicate a shift in market sentiment. Additionally, the impact of high mortgage rates on home sales and declining market breadth further support the bearish stance. Investors should consider these factors when making investment decisions and adjust their strategies accordingly. As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.